Earnings season has been a lot better than had been expected, and last week we decided we're probably not going to get an earnings recession. What does that mean for the market and where prices stand?
Yeah, I think this quarter, Becky, is turning out certainly the best you can say about it is much better than feared. I think that's kind of the bottom line. With all the downward revisions leading into it, earnings come out much better than feared, and so did economic growth with the GDP report we got last quarter. I think as we go forward, I think it's a good sign that companies and the economy didn't slow down near as much as we anticipated, just a quarter ago. And perhaps it's second quarter here, as we get into the summer and start reporting second quarter earnings, will not have so much, better than feared, but maybe just good, better earnings. I kind of suspect that growth is going to stay stronger than people expect, even in the second quarter. And I think international economies are picking up as well. And so earnings may go from better than feared to just better and good. And that could be the second driver for this rally in the second half of the year.
You think the wall of worry that we've been climbing to this point has served a purpose, and maybe there's still room to run because of that?
I think so, Becky. I mean, it was interesting, the Barron's had the article on the big money poll over the weekend, and one of the things that came out of that poll was that even the bulls are anxious about this market, even though it's come up and continues to go up. I think there's still a lot of concern. In the second half of the year, we might finally turn, concern about recession. That's starting to fade, but maybe we'll start to come to a consensus that the economy is not only recessing, it's recovering. And if we grow, 2.5%, 3% and earnings start to rise again, we may take this market from a multiple market advancing to one that's earnings driven again.
Paulsen, it's weird how guys like you sometimes end up in the right place for the wrong reasons, I think, and you've been pretty bullish. But have you downgraded your inflation outlook, and are you ready to throw in the towel on this long-running idea that you had that was going to be sort of
No, he's still worried about it, about potential overheating. Am I right, John?
Well, absolutely, Joe.
This is like waiting for Godot. This is like 5 years for you now at this point. We still got no inflation.
Well, I don't agree with that, Joe. I mean, last year, inflation went up to 3% on CPI. Wages are now above 3.5%. Or up to 3.5%. Right. The bond yield went up to 3.25%. The Fed tightened over the last few years, all because of one reason: we were overheating. And quite frankly, if the economy didn't shut down under the heat of the increase in interest rates last year, this recovery would have probably ended because of overheat pressure. And we haven't moved the unemployment rate away. So if we start to grow again, I think a lot of that pressure will come back. Now, I don't think that's probably likely until next year again. But certainly overheat's already been a part of this cycle, and it'll come back. I never said we're going to have runaway inflation.
We grew at 3% last year, and we grew at 3.2% in the first quarter. What do you mean if we start to grow again? When did we stop growing?
Well, I think I think we slowed down, Joe. I mean, the economy, the global economy, as well as here, slowed down under the housing statistics came way off under the weight of higher mortgage rates. Auto sales have weakened. So there's certainly been slowdown evidence. But I don't think
what were we doing in the mid-aughts or whatever we call these? Anyway, we'll go to RJ. I don't know. The whole reason we're doing so well is because inflation has really sort of has not been the problem.
I agree.
Jim. Okay.
Although, RJ, you have now gone to neutral in terms of your view on yields, because we've heard from the Fed that they're slowing down. Talk a little bit more about that.
Sure. I think if you look back, we are probably at the tail end, if not the end, of the Fed's normalization process. Started with tapering, moved on to tightening. The Fed perhaps tightened a touch too far, as evidenced by the market tumble of the fourth quarter. When they called off the dogs on tightening, it sort of supported the improvement in markets and the outlook that you all have been talking about. I think the Fed is now truly at neutral themselves. I think the majority of the FOMC now believes they're not sure if the next move is up or down. With
How is that possible with what Joe
being
just said, talking about how growth was 3% and now it's 3.2%? Growth is here. So why are we talking about the Fed being at neutral?
Because inflation, as Joe just mentioned, has been extremely benign. The Fed has been unable to structurally hit their inflation target for many years. It's true, it was above their target briefly, but on net, the Fed is not totally sure how the inflation process works. Expectations are very important, and we have almost a generation of people who've been in the workforce now who have seen very low inflation for very long. And the Fed is considering now layering in a new sort of operating framework to allow inflation to heat up. I think we might be moving from an era where the Fed was preemptive, it started with Volcker, now to an era where the Fed is allowed to be reactive. Because if inflation expectations are so low, the Fed does not have to preempt anything. They can allow inflation to build, and they know how to stop inflation. It's easy. Volcker showed us how to do that. How do you build inflation? That's the challenge. So you have a dovish Fed for a while.
Does that mean we are basically waiting to see the whites of inflation's eyes before you ever see a move higher again?
I actually think we are. And that sounds odd for a bond manager because it feels like that should drive term premiums, risk premiums higher, and steepen out curves. But if people are unsure how inflation actually works, and in fact doubt whether central banks can build inflation, we have unemployment near a 50-year low. We have massive balance sheets all over the globe, and inflation is too low in China, the United States, Europe, and Japan. So clearly, waiting for the whites of its eyes might not be such a bad idea. Global competition, which is being challenged somewhat by the administration's trade policy, is there. It's a huge element of disinflationary forces across the globe, and I think that that's a big factor going forward. The Fed's Phillips curve framework is highly in doubt. I don't know if it's dead. I do believe stronger wages and stronger growth can feed through to inflation, but it may be necessary but not sufficient.
So, RJ, I'd say if you're a gambling man or if you're a betting man, but you are, it's your job to kind of advise us what you think is going to happen. If the Fed is actively trying to incite some sort of inflation, do you think we're more likely to look like Japan and have that fail, or do you think we're more likely to look I don't want to say like us in the 70s or something, but you think we're more likely to actually see some success with that and see inflation pick up? What would you be telling investors who are trying to figure out how to make long-term bond purchases based on that insight?
Sure. On net, we have felt that interest rates would gravitate higher over recent years. I think now with the Fed probably done in their tightening, the 10-year Treasury has converged to the top of the Fed funds target range, right around 250. If I had to bet, and we like to make informed bets, not just speculation. Right. We think that inflation, they'll have some success in bolstering inflation. I don't know whether they'll be able to drive it sharply higher. The Fed's goal is to have that 2% target truly be symmetric. And in order to do that, they need to print probably a number of readings where the year-over-year rate of core inflation, in fact, exceeds 2%. That suggests patient pause, maybe the end of tightening. Inflation should build gradually, but if inflation expectations remain low, we don't face a lot of risk of inflation becoming out of control. That doesn't mean the Fed couldn't tighten again if inflation prints at 2.5% for 3 months. They probably would. But if they did, I bet the markets would react in a similar way to the fourth quarter, which helps to correct the excesses and keep inflation under control.
And Jim, very quickly, just to boil it down, you would tell people to still continue to buy here based on what we've seen in earnings to this point.
I would, Becky. I think the surprise second half is growth stays strong, probably closer to 3%. And this is even new for me. I thought we'd slow down more, to Joe's point, but we haven't shown evidence of that. And I think we're going to move from a multiple-driven market to an earnings-driven market. And if it does stay slower, then I think the multiple, which is 19 times trail right now, I think that could go above 20 times earnings. If bond yields are going to stay at 260 and the Fed's on hold, then I think the multiple will creep higher. Either way, you could certainly see this market maybe trade up as high as 3,400, and it wouldn't be super out of bounds in that environment. So I'd still stay tilted on the bullish side of things.